But if you look at EU, so let's look at this. So if we go from a basic technical standpoint, we are on impulse and potential corrective, right? Now we've broken out, we kind of broke out from this potential corrective at this point in time and had certainly a bearish bar here, right? An inverted hammer. That is a bearish sign. What do you expect to happen? Let's say we don't see this, okay? We don't know what's happening here. What do you expect to happen at this point in time? After you see this price action, it's digested enough, we get a kind of a breakout and certainly inverted hammer, a bearish sign on this daily chart. Remember, daily chart is quite an important chart and certainly a valuable chart. What do you expect to happen from this bar here? You expect the market to move to the downside, right? You'd expect that because very basic trend theory is impulse, corrective impulse, right? And the price action we're getting here is digested from this impulse. We think about the 70-30 rule. Okay, markets trend 30% of the time, markets digest 70% of the time, or approximately. So we can see here we've probably had a week or something of movement to the downside, and it's taken some time to digest that. But what then happened yesterday, if I remove this, is we get this again, this bullish hammer sign. Okay, so when you're expecting that move to the downside, certainly from a conformational bias like this hammer coming on increasing volume, but we get this, it puts a little bit of doubt in your mind of this continuing to the downside because you're expecting this to melt down. Okay, but not only did we get this bar, what have we got this bar in terms of? I mean, everybody's going to have a different answer to this, but what also do we have within this bar that adds to that kind of unsure that this is going to move to the downside? What adds confidence that maybe Euro USD wants to move up? So, okay, I'll tell you the answer is increased volume. So look at the volume coming in on this particular bar. So again, you're having at this point in time, you think about the psychology of markets, you're expecting this to fall. We've had impulse, corrective. You think about Dow theory, primary trend to the downside, secondary trend, corrective, and then we continue with that. But we've got an immediate rejection from breaking out of this corrective. We've got higher volume coming in, again, putting doubt in the minds of Euro USD seller, and we get a reaction like we have right now. So it's important to know, and this is why I think volume is great to look at. Where does the volume come from? Institutions. Who moves the markets? Institutions. We got, us as retail traders. If we put everybody, all us retail traders in a room and we clicked sell the Euro USD, do you think we're going to have any effect on this market? No. I mean, I'll answer the question. No, we're not. So volume, I think, is a great indicator, and that's just a little good case of what I kind of look for, and why my bias to the upside was. I mean, it was I don't get everything right, but that was ultimately right on Euro USD. But I didn't make any money from it because I didn't get the setup. As I said, I need a kind of corrective in there. Wick, how can we escape from this kind of fake breakout? So Arun, the normal thing I would say, okay, if we look at, and I'll give you a good example because somebody asked me about this yesterday. Okay, I'll give you a good example. If we look at New Zealand Swiss, and Euro USD is probably not the best example because the chart wasn't looking too bad for a move to the downside. But when we're seeing these massive extensions, certainly on a higher time frame perspective, this is where we see a lot of fake outs. So this is where my premise of, I call it RTM, is basically ready to move, is a chart ready to move. And looking at New Zealand Swiss yesterday, if you look at this wick, that has certainly trapped some retail buyers that want to buy New Zealand Swiss to the upside because it's risk on, etc. But what they're not understanding, or what they're not grasping, is that we have already had that move. When price action gets a little bit too extended, that's where you see fake outs happen. And I promise you'll see it time and time again. So even if you have a 15-minute, 30-minute, 1-hour setup breaking out from a certain structure, and you go over to the daily charts and you see price action that looks like this, that looks like, okay, let's go back to, New Zealand yen is another good example, right? That looks kind of like this. Actually, that's not a good example, but New Zealand Swiss is probably the best example, sorry. This is where fake outs occur. So RTM, using a simple thing like a 20-period moving averages gets you into trades at the right time. I'll see if I can give you, okay, I'll give you an example of that. I'll show you a trade that I took from quite some time ago, which was the Swiss yen. I'll see if I can find it. And then I'll go into your charts, etc. I'll do all that in a second. But I think this is an important concept that some of you might not know. It was probably later point of last year here. Yeah, I'll go into your charts after this. I'll go into charts. I've got one thing that I'm looking at, then I'll go into your charts as well. So my setup on Swiss yen, okay, was back here. I've got a larger V reversal, a nice corrective in, a push through, again, V reversal within a V reversal within a V reversal. The essence of the context is that we've rising pressure into that area. Okay, we've got crossovers of that moving average. You've got crossovers of that 200 MA, which is good. You want to be on the right side of these moving averages because they're areas of dynamic support to price. Okay, so we always want to go, majority of the time, we obviously want to go with that trend because the trend is our friend. Okay, but if we look at, and also a little bit of a note here, Swiss yen is my favorite pair, right? So Swiss yen, I know in terms of fibs, if you like the fibs, likes the 38.2. So this movement down here was actually hitting the 38.2. This push down here, this actually hit here, the 38.2. So it's an important concept in terms of knowing your pairs and like knowing how each individual pair works. It's called market characteristics. So that's something that is if you don't know, you're taking a trade on a certain pair, write down the characteristics of it. GJ moves differently from Kiwi dollar. Gold certainly moves differently from Euro USD. So they're having the characteristics and how they move is also a great skill that you can have.
Let's face it, if you're trading Forex without a winning trading plan, you're gambling. You need a model that is going to long-term net you a profit. Our team has put together a free guide on how you can actually create a trading plan.
All you have to do is use the link down below in the description.
Send the word template to our team on Telegram and we'll send you a copy. Again, hit the word template in your Telegram, send us a message and we'll get back to you with a copy of the free trading plan template.